Imagine waking up tomorrow and realizing your money is still there, but you can't touch it. You open your banking app, it doesn't load. You walk to the nearest ATM, out of service. At the store, your card gets declined. At the gas station, they only accept cash. At first, you tell yourself it's just a glitch, but then something feels off. You step outside, and suddenly you're not the only one. People are gathering near bank branches, checking their phones, talking in low, tense voices. The lines start growing, not slowly, but all at once. Like everyone realized the same thing at the same time. Inside stores, shelves begin to empty faster than they can be restocked. No one is explaining anything clearly, but everyone is reacting. The news keeps repeating the same words: temporary measures, system stability, precautionary actions, but none of it sounds reassuring. And that's when it hits you. This isn't a glitch. This is the system protecting itself. Because your money was never just sitting there, waiting for you. It wasn't a stack of bills with your name on it. It was part of a much bigger machine. Moving, circulating, being used somewhere else, right now. What you thought was your balance was really just a number on a screen, and now that screen has gone silent. The illusion starts to crack. This might sound extreme, like something that only happens in broken economies or distant countries, but history tells a very different story. Because this has already happened, more than once, in completely different parts of the world. In 2001, Argentina's financial system began to collapse under pressure. People rushed to withdraw their savings, and the system couldn't keep up. So the government stepped in. Withdrawals were limited, accounts were frozen, and dollars were forcibly converted into a weaker currency. Years of savings lost value in a matter of weeks. Not because people made bad decisions, but because the rules changed overnight. A decade later, in Cyprus, the crisis returned in a different form. This time, it was called a bailout. Banks didn't just freeze access. They took a portion of large deposits to stabilize the system itself. Not investors, not institutions, ordinary people. Then came Lebanon, where people technically had money in their accounts but couldn't access it. Imagine that for a moment. Your money exists, but your life stops anyway. And maybe the most uncomfortable example of all comes from a place most people assume is immune to this. In 1933, during the Great Depression, the United States shut down its entire banking system. For 4 days, banks didn't open. People couldn't withdraw money. Businesses couldn't operate normally. Not because the country had no money, but because it was losing something far more important: trust. And once trust starts collapsing, even the strongest systems can freeze. Because banks don't work the way most people think they do. When you deposit money, it doesn't just sit there waiting for you. A portion is kept in reserve, but the rest is loaned out, invested, and circulated through the economy. That's what makes modern economies grow. But it also creates a hidden weakness. Because if everyone wants their money at the same time, the system simply can't handle it. So if banks don't really hold all your money, what keeps the system running? It's not reserves. It's not regulations. It's belief. As long as people believe their money will be there, they don't rush to take it out. And that's what keeps everything stable. But the moment that belief cracks, everything changes. A few people withdraw first, then more follow. And suddenly, it's not a reaction anymore. It's a chain reaction. And panic doesn't spread slowly. It spreads faster than any policy can respond. That's when governments step in, not to slow things down, but to stop them. Withdrawals are limited. Transfers are blocked. Access is restricted. They call it protection, stability, emergency measures. But in reality, the system is being protected from collapse, not necessarily you. Because when things break, the priority is to save the structure first. And when the system starts to freeze, the impact doesn't stay inside banks. It spills into everyday life. Salaries are delayed, not because companies don't want to pay, but because they can't move money. Businesses struggle to operate. Suppliers stop delivering. Everything begins to slow down. And then something more subtle happens. People stop trusting the system entirely. They start hoarding, not because they want to, but because they're afraid of what comes next. Markets react. Assets are sold. Prices swing wildly. Retirements shrink. Savings lose value. Plans disappear almost overnight. And suddenly, this is no longer just a financial problem. It becomes social, psychological. The most dangerous part of this story is that it doesn't feel dangerous anymore. Because today, money feels easier than ever. Faster, simpler, always within reach. It's in your phone, your apps, your digital wallet. One tap, and it moves anywhere in seconds. That convenience feels like control, but that feeling can be misleading. Because what you really depend on is access. And access can be restricted, slowed, or completely cut off. The less physical money becomes, the easier it is to forget this, because you don't see it, you don't hold it, you don't question it. Until one day, you can't use it. And that's when everything changes. So what do you do with all of this? Do you panic? Withdraw everything? Abandon the system completely? Not really. Because the goal isn't fear, it's awareness. The system isn't useless, it works. Until it doesn't. The real mistake is depending on a single door and assuming it will always stay open. Resilience means having options, not extreme ones, just practical ones. Different forms of value, different places, different levels of access. Because real ownership isn't just about what you have, it's about what you can actually reach. And when systems are under stress, access becomes everything. This isn't about escaping the system, it's about not being trapped inside it. Because the strongest position is having a choice. There's one more layer to this story, and it's the one most people don't think about. We often treat financial systems as neutral, as if they simply exist to serve everyone equally. But history shows something different. In times of crisis, decisions are made very quickly, and those decisions don't always prioritize individuals. They prioritize stability, structure, control. Because when systems are at risk, the goal is to keep them alive, even if access is temporarily sacrificed. That doesn't make the system evil, but it does make one thing very clear. Your relationship with money isn't just financial, it's structural. And structure comes with rules, rules that can change. So maybe the real question isn't, what if banks shut down tomorrow? Maybe the real question is, what would you do if they already have?